Hello, I'm Jim Cunningham. Today we're going to talk about cryptocurrency, the hot tax and estate planning issues. We get a tremendous amount of questions on crypto, how it's taxed, and what happens when you pass away or when you give it to somebody else, and also when you spend it. So we're gonna cover that. This is a disclaimer. I am not a crypto expert. I'm a lawyer, and I'm looking at the legal side of how crypto is handled. This is very important because many of our clients have rather significant crypto holdings, and it is now becoming quite an issue for a lot of people. So go ahead, subscribe to our YouTube channel. Got a lot of great content. Again, I'm a lawyer. I'm talking. This is not legal advice. This is information only. And subscribe to our YouTube channel. There's a lot happening in the world now and a lot of tax law changes. And so it's really good just to stay abreast of all the changes that are going on. So I'm a lawyer. I'm the managing partner of CunninghamLegal. I'm a certified specialist in estate planning, trust, and probate law. I have over 25 years experience. We have offices in the San Francisco Bay, Southern California, and Capital Region, which is the Sacramento area. I'm securities and insurance licensed, as well as a licensed real estate broker. Again, I'm not a crypto expert. And I will tell you, in talking to other lawyers, we're kind of looking at each other saying, wow, this is becoming an issue. How do we deal with this? So there are really three big issues here, even though it says two. Number one, how is crypto owned? Okay, so what is ownership? Okay. Secondly, how do you gift or inherit crypto? And how is it taxed? These are really, really important questions, and we're going to kind of unpack this as we go through today's materials. So let's just briefly cover ownership. And when you buy a car, you take ownership of it, right? You get the keys, you get a title, you have physical possession of it, you drive it around. When you buy a house, you get the keys, there is a deed, there's a piece of paper, okay? It's recorded at the local county recorder's office. You are the owner of the property. You can live in it, right? If you buy a puppy, you take ownership of the puppy. Now, it may be a registered animal, it may not be a registered animal, but there's typically no title to a puppy. But if you buy a puppy, you own the puppy. So ownership is, obviously the state relation or fact of being an owner. But how does this fit with crypto? Okay. Is there a title like real property or a car? There isn't. Can you take physical possession of crypto? No, it is an intangible. How do you transfer crypto? We'll talk about that. But before we really get there, it's important to understand the difference. And this is real, like super basic. So again, if you're watching this and you're a crypto expert, you can be like, I can't believe you're talking about this, Jim. It's the difference between a spreadsheet and a database. And then we're going to talk about blockchain technology. So a spreadsheet, it's like Excel or Google Docs. Typically, it's one person or a small group of people that stores and access information, kind of limited amounts of information. A database, on the other hand, is designed to house significantly larger amounts of information that can be accessed, filtered, manipulated quickly and easily by large numbers of people simultaneously. Okay, so oftentimes a spreadsheet, you can't do that. It just doesn't work well. But a database, you can have lots of people, literally millions of people looking at this at any given time, and is a collection of large amounts of information that is electronically stored on a computer system. So it might be multiple computers across a network, but it's on a computer system. And what is blockchain? Blockchain is a very specific type of database. And what it does is it stores data in blocks or buckets, right? And as these fill up, they are chained together. So you fill up data in one block, and then once that's full, you have a chain, right? That's linked to the next bucket that's full. And these are done in chronological order. So we have a graphic here where you have a block, and then you have a series of records or transactions that are available for anyone to see, that are then chained together. So this is a massive amount of information that is continually being created, okay? And the most common use so far, blockchain technology, is a ledger for transactions. That is crypto. I do not like the term crypto. I do not like the term currency, because this is not currency. We'll talk about that, how the IRS taxes that in a little bit. But with Bitcoin, blockchain is used in a decentralized way so that no single person or group, and I put in there probate judge, because if you become incapacitated or pass away, who gets your property? A probate judge ultimately decides who gets your property. That's just our system in California. That's our system in the United States. A probate judge is the ultimate authority. You know, if you die and there's a dispute as to your real property, your home, who's going to ultimately decide that? It's going to be a probate judge. Okay. But no one has control of crypto. Nobody. The users collectively retain control, and no one person can alter the outcome. So what we have are decentralized blockchains that are immutable. What that means is once the data is entered into the block of data, you can't undo it. You cannot pull the cream out of the coffee. You cannot unring the bell. It is permanent, irreversible, and will live on literally forever, right? As long as there's the blockchain network is up and running. And very importantly, it's viewable to anyone. Now it's anonymous or pseudonymous. It's encrypted with numbers, so it's not necessarily a name like you might see with a deed, but still that is public information, effectively public information. Anonymous asks, can I transfer my regular investment accounts into an LLC and distribute income to the beneficiaries? You could. That's a different question. We would certainly want to look at that. Typically, people transfer the LLC interest to a beneficiary in a variety of forms, a gifting trust or whatever it might be. And then the income is oftentimes distributed to them. It depends on if it's taxed as a partnership or a corporation as well. Can you put the blockchains into a trust? We're going to get into that. So can you put crypto into a trust? The short answer is yes, but in a roundabout way, and we'll definitely cover that. So blockchain technology, again, operates autonomously on its own. This is really important. This is outside the jurisdiction of California, outside the jurisdiction of any country. It's kind of like saying, you know, between here and Hawaii, where I'm in California, between here and Hawaii, at the dead middle, who owns the air over the ocean? Nobody, okay? Nobody has control over that, all right? The traditional legal instruments like contract law are not required, and they don't really fit, okay? It doesn't really work because a contract is ultimately enforceable in the jurisdiction that the contract says. This contract's made under the laws of California. It doesn't really work that way because no crypto transaction that I'm aware of says if there's a dispute, a judge in California is ultimately going to decide who ends up with the crypto and who doesn't. There are no intermediaries required, and this is a peer-to-peer. This is a person-to-person, unlike a bank. Okay, you can send an email instantly, but it takes hours to get a wire transfer. I mean, I don't understand why that's the case. But there are no intermediaries like you have as a bank. This is one person and another person, and you can buy and sell. You can lend. You can borrow, you can deposit assets for staking, if you need if you're going to perform a transaction where you need to withhold a certain amount of money. With this blockchain architecture, you can do pretty much everything you can do with normal property. And that's the key, is this is treated, the United States government treats this as property, not currency. It's very important to understand the difference between the two, and we'll talk about that. So enforcement of blockchain technology is automatic by achieving consensus with all the users. So you've got all this information being continuously reported in a permanent record, and everyone can see the permanent record, and there you have it. So it is automatic. And here's the interesting thing. Blockchain does intersect with the legal systems and does produce legal consequences in your daily life. Ownership of crypto is key, and that's kind of a pun. The pun is intended because you have a key, which is your password. That is the key, and so the key is key, right? That password, whoever holds that password is presumed to be the owner of the crypto, okay? Now, let's talk about smart contracts. So a smart contract is where two people come together and they say, what two people come together and say is, we're going to put some code into the blockchain environment. And as soon as I do this thing, like push this key, like this keystroke, when I press enter, my crypto is going to go to this other person. Okay. And it self-executes, meaning I push the key and the counterparty, the person I'm giving this crypto to, now has the crypto and I don't have it. And that's done by code that is written into the database. Again, I'm not a technology expert. I'm just giving this on a very high level. This is actually highly relevant on how you should hold this, whether it's in your living trust or individually. So again, this is a distributed, decentralized blockchain network. It's very important. These transactions are all trackable and irreversible. You cannot, again, you can't pull the cream out of the coffee. You can't unring the bell. And so what we have here is on the left-hand side, upper left-hand side, two users create a smart contract. They write some code. The smart contract is stored in the blockchain. And when you hit that return key, then the contract self-executes and the crypto goes from me to you, for example. And we have a chat question. Can you put the blockchain into a trust? We'll talk about that. What is the advantage of owning crypto? I don't know. Look, crypto, truth be told, this kind of scares me because I don't really understand it fully. I mean, I think I understand it. If I don't understand something, I'm not really motivated into putting any money into it. And so a lot of people, you hear a lot of smart people who are critical of crypto and a lot of smart people who say it's the best thing ever. So, there you have it. What in particular does one meet to find out the issues in crypto? I'm not sure I understand that question. So smart contracts, that's just a thing you might hear about. A smart contract, it's just code, you hit return and the crypto moves from point A to point B. Crypto can be held, used, and disposed of. It is a property right. It's an intangible personal property right. So Bitcoin, an intangible personal property right, does not have any physical presence. So you might see a graphic of a Bitcoin that's gold with a B and some bars on it, right? Like an S, like, United States currency has an S with the bars. But understand, no one's minting Bitcoin, that the physical coin. That's just not, at least not yet. Traditionally, property, this really gets into a kind of a fundamental concept in law. What is property? Property is typically acquired in ways that are described under national law. So the law of the United States defines what property is. The individual states define what property is. The United States government defines what income is, okay? And they tax you on it. They define what property is and they tax you on it when you pass away. So this is, if you possess it, that's an incident of ownership. If there's an agreement, typically that's an agreement that's enforceable by a court or by prescription. It's literally where you take it and hold on to it like adverse possession, okay? But it's really important to understand that crypto lives outside of this architecture, lives outside of this structure. And so enforcement of crypto rights, I don't think you can go to a court and get enforcement of crypto rights. A court can order somebody to tender a key, right? To tender the password, but I don't see how a judge can order the blockchain network to do one thing or another. So I think that's, if there's a big takeaway from this today, is that crypto lives outside of the United States, okay? So again, the private key, you can think of it as a password, is a form of cryptography. And again, the transfer does not rely on any legal rules. It's simply, hey, you've got this account and a password, boom, you're done, okay? Whoever has a private key fully controls his or her cryptocurrency stored in the corresponding public addresses, okay? So this is really important to understand. Whoever has that password, that's it. That's kind of the game. So how do you put, part of this is, how do you put a password into a trust? Well, you don't, and we'll talk about what you do, best practices in a couple of slides. So and so this creation, where does crypto come from? Well, it's minted, or it's issued, or it's mined, okay? And so it goes to the public address of the first possessor. So you can mine Bitcoin, and it's a process using computers, and poof, you have a 1 Bitcoin, and so you would be the first owner in this example, and you have a key, you have a password, and so you're the first possessor. And you, as the first possessor with your key, you have the right of ownership. And under law, right? Under law, whoever holds the key, that's prima facie, which is presumed ownership if you have the key, and that evidences or proves that you own this crypto if you have the key. If someone has stolen your key, you have to prove that they stole it, but they still have the key. So whoever holds it's like, you've heard possession is 9/10 of the law, which is not really legal. I guess in this case, possession is 10/10 of the law. So the private key is where it's at. Transfer of ownership to a third party is mainly performed by agreement on behalf of the possessor. So if you're going to, again, this is the smart contract. If you're going to transfer crypto to another person, how do you do it? If you can't pick it up and hand it to somebody, well, you write up a smart contract and you hit return, and then your counterparty, the other party, the recipient of the crypto receives it. And that's done through this digital signature and private key. The digital signature is used, and this is really important, to prove that the owner owns the crypto without revealing the private key. Okay, so the private key, it's not like you give your password to somebody else and you say, okay, now here's the password to this crypto, but they don't see your password. You transfer that property by this smart contract, and now they have the crypto, you still keep your key. And once they're broadcast to the network, the transactions cannot be modified. Okay, again, something, just a takeaway from this is blockchain technology. It's like it is carving it in granite, literally, and maybe that's why they came up with block. I mean, block is like a section of information, but you can also think of block as a block of granite. So this thing's carved in granite. You can't change it. Okay, so the third party who receives the crypto assets to his or her public address becomes a new owner, new key, and the third party has the private key to this address. Okay, so that's how it works. You keep your key and you do a smart contract, and the crypto transfers. So the funds leave the control of the sender and go to the recipient. Now, there's everything I've just described, there's a really big problem. How do you deal with this with an estate? Some of our clients have hundreds of thousands, some have millions, some have tens of millions of dollars in crypto. All right, this is really important stuff. So what's happened is crypto owners have transferred their crypto assets to the wallet of a third party. Okay, so this is where I'm going with this, and this is kind of the tee up for something to consider. If you own crypto and you're worried about, hey, what happens when I die? Does this crypto just go away? What if I lose my key? What if all these bad things happen? You can engage a third party, and Casa, Exodus, Electrum, Mycelium, Ledger, Trezor. These are all, they all have performed slightly different functions. And if you own crypto, one of these might be right for you. None of them might be right for you. I actually opened up a crypto account in doing research for this with Coinbase. And Coinbase, you can hold crypto at Coinbase. And so Coinbase acts as a third-party intermediary that holds either the key or part of the key or a duplicate key or whatever it is, okay? And again, all these structures are different. But the idea is there's a third party that's holding on to it. So if I die, my trustee, maybe I put that into my trust. So this answers the question, how do I put crypto in the trust? Well, you set up a wallet with a third party, one of these companies down at the bottom, and you say, look, I'm going to put this in my living trust. So if my trustee shows up with the right documentation, with the right data, effectively, then my trustee can take control of this crypto asset. So this functions much like depositing your money in a bank, but it's very important. These companies are not banks, okay? They do not have the same regulation. Can they steal from you? Yeah. I mean, I'm not saying that these people would steal from you, but is it possible if you give your money to a third party? What can go wrong? Yeah, the custodian's wallet can be hacked and they're not able to return the funds. Is it possible? Yes. Is it likely? I don't know. All right. This is just a risk element. You transfer things that can go wrong with crypto. You can be cajoled into transferring your assets by mistake or by fraud. Okay. And that's a risk. Sort of the Nigerian prince says, give me 100,000 in crypto and I'll give you $10 million in 2 minutes or something. You've heard of those scams. Also, a third party can kind of cajole you into disclosure of your private key and steal your crypto assets. So this isn't you necessarily like sending them crypto, somebody steals your key. So again, these assets exist outside of the law, and therefore a court order, in my view, is likely ineffective with respect to the crypto and blockchain. A court really has no ability to make an order to give you back your crypto. Okay. Now there are some court cases that have come out where people have proven it and gotten it back. But, again, the extent of the jurisdiction of the court is limited, okay, and limited by nation, and this exists outside of a nation. So you have issues of, well, is the court order against the person who happens to be within the borders of the nation? And there were a couple of cases in Britain. So courts are empowered by law to reverse transactions. If somebody steals something from you, the courts can reverse those transactions. But the problem with blockchain is once it's confirmed by a blockchain network, the transaction is valid, irrevocable, and stored in a distributed immutable ledger. Okay, so that's a real disconnect there, right? A judge says, oh, you have to give it back. Now the judge can force a person to put their key in and give it back, but a court cannot alter the blockchain record itself. So it's very important to understand. So even though a hacker illegally obtains crypto assets, they can dispose of them, and then it gets really difficult to recover them. So there is some risk here. Crypto is transnational. And what I mean by that is the private law of a nation, every country that's a country, right? They have laws. And each country treats cryptocurrency differently. Some treat it as a commodity. Some treat it as property. California or the United States treats it as property. Some treat it as money. The United States government does not treat crypto as money. Cryptocurrency is a misleading term because I think it conflates it with money. It's probably crypto property is better, but it doesn't sound as interesting. Anita asked, does crypto have economic value of any kind? I don't know. It's a mutually agreed value. It's a store of wealth. I don't have an answer. I'm not a crypto expert. Now, an owner of crypto may be required to prove that he has obtained his rights to the assets from a legal owner. It's possible to prove that. But Amy says, but it can be used like money. That is correct. It can be used like money. And I'm not, dissing crypto at all. I'm just saying that if you have crypto and you're worried about like, okay, how do I transfer this when I die or get sick? You have a key and you can give someone the key, but now they have the key. And you better trust that person. You can also seek out the help with a third-party wallet. To get your stolen crypto back, you got to go through a lot of stuff because there's this pseudonymous character where you have a number and a password, but you don't know who the person is. So it's kind of hard to locate it. And frankly, if they're on a privately hosted blockchain, there's secret network or incognito network. They are fully confidential and untraceable. This kind of makes me a little nervous. If you have crypto, you need to know the structure of the network. And if this is a secret if it's secret or incognito and it's fully confidential and untraceable, you just have to know that and be comfortable with it if you're going to put money into it. So the key is the key. What that means is the mere possession of a private key, which is essentially, think of it as a password, should be considered sufficient to prove crypto assets ownership. As I said, prima facie, it is sort of you're presumptively the owner if you have the key. And unless you can prove otherwise. So he who holds the key gets the crypto. Let's see here. We answered that. And let's see. Wendy says all reasons to keep crypto in several areas and not all in the same wallet also have high security on whatever devices are used. Wendy, absolutely. I couldn't agree with you more. If you have significant crypto assets, you need to pay attention to this. I'm just going through how it's taxed and how it's owned. This is very high level. This is not, I'm not a crypto expert. I'm a lawyer who helps clients with crypto assets. Okay. So best practices, safeguard your key. There are two components to that, safe and guard. When I was doing research for this, I came across a blurb of a guy in Britain who had his key stored on a hard drive, and he threw the hard drive away and it went to a dump. And it had hundreds of millions of dollars worth of crypto on it, and he was unable to recover it. So safeguard your key, keep that. Consider using a third-party wallet provider. Really pay attention very closely to digital security. In our law firm, we use two-factor two-factor authentication. We do not store client information in our offices. It is all digitally stored in a server. I believe it's in Las Vegas with armed guards and a floor that's cooled by water. So we take data security very seriously in our law firm. When you walk into our law firm, in fact, you don't see files because we just don't have that paper laying around that's very easy to steal. So consider having your successor, trustee, or executor have access to your key when the need arises. How you do that, I'm not quite sure. This is really kind of real time. I think it depends on everyone's unique situation. But that's something that I think if you have significant crypto assets, you really need to figure out a way to have that key be provided to people. And so they don't just throw it out with when they clean out your residence. Okay. So let's move to taxation of crypto. Fortunately, and if you have questions, put it on the Q&A. If you have questions, if you're watching this on YouTube, this is being recorded and will be put on YouTube. You can go ahead and put them in the comment section. So notice 2014-21, which is, shocker from tax year 2014. Notice 2014-21 describes how existing general tax principles apply to crypto using virtual currency. And they did this in an FAQ. And what I'm going to do is I'm going to go through the FAQ and comment on it and a little bit of translation. It's very important to note that the IRS acknowledges that virtual currency, it can lawfully be used to pay for goods or services and be held as investment. Okay, so this is something that the US government says, yes, it is lawful to use cryptocurrency to engage in transactions and hold as an investment. So that's really good news. And it is a digital representation of value that functions as a medium of exchange, a unit of account, or a store of value. So it is a digital representation. So that goes to the question, is there any intrinsic value in crypto? I think the answer is probably no, because it's a digital representation of value. It's almost like money. There was this movie a long time ago, and I'm drawing a blank on the actor's name. The movie was called Blow, and it was about cocaine trafficking in the 1980s. And one of the things that I remember from that movie is a father was sitting with his son, and he said, "Son, money is not real." And that really stuck with me because money isn't real. In a sense, the government just put in $4 or $5 trillion into the economy. Where did that come from? It came from keystrokes, and they just shoved a bunch of money into the economy. And crypto isn't real. It's an intangible, but it is a digital representation of value. So in that sense, there's no intrinsic value in the sense that money has no intrinsic value. It's a measure of worth. Similarly, crypto functions in two ways. Crypto functions like money in that it's a representation of value, okay? And it's also an investment. So it kind of puts the two together. And so frankly, I mean, it's kind of new. So it can operate like real currency. It's very important, but does not have legal tender status in any jurisdiction, okay? So it can be treated as money, but as far as I know, no jurisdiction has said this is legal tender. What does legal tender mean? When you pay your taxes, the government does not accept Bitcoin. The federal government, state governments do not accept euros. They don't accept Iraqi dinars. They accept US dollars. That's the only way you can pay taxes. And that's what I mean by having legal status, legal tender status, okay? It's basically the government's, the backing of the dollars, the government's power to take those dollars out of people's pockets through taxation. So virtual currency that has an equivalent value is called a convertible virtual currency. This is right out of the IRS. For example, Bitcoin is a convertible virtual currency and can be digitally traded between users and purchased for an exchange for dollars, euros, and other real or virtual currencies. So what I mean is I can say to a counterparty, I will give you $1 worth of Bitcoin for that pack of gum. Okay, or I can exchange Bitcoin for dollars. Okay, I can sell that on the open market. So that's what that means. Matthew says, oh, hey, Matthew, how you doing? El Salvador passed a law by supermajority 2 weeks ago recognizing Bitcoin as legal tender equal to the US dollar. They're otherwise a dollarized now Bitcoinized economy. So we've got one that has, what is the current value of Bitcoin? If anyone wants to comment, I think it's in the 30,000s for one Bitcoin. But El Salvador, it's about 34,000. Matthew posts about 34,000. Thank you, Matthew. So Under US law, the sale or exchange of a convertible virtual currency or the use of virtual currency to pay for goods or services in a real world economy transaction. This is super important, has tax consequences that may result in a tax liability. So when you use this currency, it has multiple tax consequences, and I'll unpack this in the Q&A format. So Nicole says, I'm confused. I thought initially you said Bitcoin is not currency, but now you're quoting IRS saying it is currency. It is like currency. So the US does not treat, this is important for taxation purposes, the United States does not treat Bitcoin as currency. It treats it as property, and that has a different tax consequence. Okay, so this is the first question. How is virtual currency treated? For federal tax purposes, basically the states go along with the feds, right? Virtual currency is treated as property, and general tax principles apply. So what that means is if you buy Bitcoin, if you buy a sliver of Bitcoin for $1 and it goes up to $10, and you use that $10 to buy something, you realize $9 in gain. That's the tax consequence I'm talking about. So if your Bitcoin, if you buy low and you use Bitcoin to buy a good or a service in the United States, when that good or service is purchased, you potentially realize a gain, right? So if you buy something for $1 and sell it for 10, so what the government's doing is they're saying, hey, if your Bitcoin's gone up in value and you spend a little bit of it, there's a tax consequence that you're going to have to track. There's a few more questions on that. We'll get to it. So is virtual currency taxed as foreign currency gain or loss under US federal tax laws? That is a separate tax structure. The answer is no. It's treated as property. Okay, it's actually a little bit easier to go through the property analysis. If you receive virtual currency for payment for goods or services, if somebody does a living trust with us and it's $5,000 and they pay us in virtual currency, I have to report that. Our firm reports that as income, right? So, so a taxpayer who receives virtual currency as payment for goods and services must, in computing gross income, include the fair market value of the virtual currency measured in dollars as of the date that the virtual currency was received. Now, Bitcoin and a lot of virtual currencies are very volatile. What is it? The date? Can you game the system and say, well, it was, the transaction occurred at noon, but at 6 a.m. the price was more favorable to me and pay less tax? The answer is no. You can't game it like that. And when that transaction occurs, you do know the price because these are traded 24/7. So if somebody pays you at noon on a Thursday, you know what it's trading for at noon on a Thursday, and you would use that number. So what is the basis of virtual currency? What I mean by basis is if I take money and I buy something for $1 and it goes up to $10, my basis is $1. So if I sell it for 10, I realize a gain of 9. Okay, so if I buy something for $1, my basis is $1 and it goes up to 10 and I sell that thing for 10, that my gain is 9, my basis is 1. I do not pay capital gains tax on my basis, but I do pay tax on the $9 gain. And so again, the basis, if I'm charging somebody for legal services and they pay me, my basis is what I charged them, right? So if I acquire Bitcoin and I do work and I pay, let's say $5,000 on that, and I get $5,000 worth of Bitcoin, that Bitcoin now has a basis of $5,000. If it goes up to 10 and I sell it, I'm going to have a gain, right? If it goes down to 3 and I spend it, I may not have a gain. I may have a loss. So where I'm going with this is, you can see this is pretty complex, and it's a lot of numbers, and it's more complex than just. It's more complex because you have this varying value that changes literally minute by minute. How is fair market value of virtual currency determined? The taxpayers must determine the market value of the virtual currency as of the date of payment or received, and it has to be reasonable and consistently applied. So you can't pick and choose. If you do that transaction at noon on Thursday, you're using the value of Bitcoin at noon on a Thursday. Who keeps tabs on the value of this for tax purposes? The IRS, Wall Street? Yeah, it's a good question. You have a duty, and as we'll see as we go through here, if you spend money, if you spend more than 600, on services. You have some other things that you need to do. How do you plan for the future? Anonymous asks, how do you plan for the future transfer of crypto if you don't fully trust your trustee to give it to your children and your children are too young to receive it? Well, Anonymous, that's the age-old question. You have to trust your trustee. That's a tough one. And that's something that, Matthew, I know you're a well-known attorney who's on here. If you want to chime in, feel free to give me a suggestion. That's one thing we're working on. Clemens asks, is trading crypto coin to crypto coin directly on the exchange considered a taxable event? If I trade Bitcoin to Ethereum on Coinbase, is it a taxable event? The short answer is yes. I would think so, yes. On the Coinbase exchange, the exchange owns the private key for Bitcoin and private key for ETF, and I do not own those private keys as ownership. I'm the beneficiary of the account that has a beneficial interest for those private keys. It is essentially a trust relationship between Coinbase and me. Okay. As you stated, if I do not own the private keys, then I do not have the ownership. So Coinbase exchanges like properties between its own private keys for my beneficiary. I would say, Clemens, I would say if property is being sold and exchanged, you're probably going to realize a gain. And Coinbase, my presumption would be Coinbase would report that, and you would have to, if you have short-term gain, that's taxed at ordinary income tax rates. So it's something to pay attention to. So Anita says, so might people own Bitcoins or crypto for tax reasons and trade, buy and sell as the values move? I think people buy and sell Bitcoin to make money or for other reasons. I'm not sure they do it to save taxes. I don't see crypto as a tax planning strategy. How is the fair market value of virtual currency determined? It's in a reasonable manner. Does a taxpayer have gain or loss upon an exchange of virtual currency for other property? Yes. And I think that answers our question for the Coinbase is, if I swap Coinbase for Ethereum, do I have a gain or loss upon an exchange? Yes. I mean, you might have a loss, right? You might have a gain. A gains, you got to pay tax on gain and potentially a deduction for a loss. Matthew says one of the better techniques for self-custody folks is to use a process called Shamir Signatures. It allows the crypto owner to fragment their private keys and distribute them to multiple trusted parties without any one of them having total control over the private key. For example, you can create a 2 or 4 or other XY number of recovery shards to allow a consensus of individuals you trust to recover your wallet if it's stolen or otherwise unrecoverable. Brilliant. It's multi-signature control. It sounds a lot like the 2 Air Force colonels who have the keys when they launch nuclear weapons, right? You'd have 2 people do it at the same time. Taxation of crypto. Yes, there's a tax on sale or loss. What type of gain or loss do you realize? It's a capital asset. And what that means is, unless it's held for a trade or business, which, I think that's probably no one on this call, on this webinar. Basically, if it's a short-term gain, it is taxed at ordinary income tax rates, which is a high of 37% federally. And if you're in California, it's up to 13.3 plus 3.8% net investment income tax. So you add up all those and they end up being a really big number. Does a taxpayer who mines virtual currency realize gross income upon the receipt of the virtual currency? Yes. When you mine the currency, it is taxable. So it's a zero basis. And then when you get this 31 Bitcoin of 35,000, it is includable in your gross income. Wendy writes, I move crypto between platforms, and that seems to be a sell and a buy, even though it's the same crypto. This is done to buy other crypto not available on all platforms. It sounds like all movement can trigger taxes. I'm not sure, Wendy, if you're selling it and then buying it again, I would need to know what the transaction looked like. But if you're essentially journal entering over the crypto, that's one thing. But if you're selling in company A or wallet A and then using dollars and putting them in wallet B to buy other crypto, yeah, that's a sale. So I think you're probably right. I doubt those are journal entered over. So the fair market value of the virtual currency is includable in gross income. If you mine virtual currency as a trade or business, subject to self-employment tax. Yeah, that's another, right? 12 point, to basically 15 when you add in self-employment tax and Medicare. So yes. Does virtual currency received by an independent contractor for performing services constitute self-employment income? Yes. So in this sense, you're receiving property in exchange for services, you got to be taxed. It's no different than paying somebody. It's like, hey, I did this thing for you, pay me 5 ounces of gold. Very similar. Or pay me a car, give me a car in exchange for work. It's treated like property. So it's includable in your gross income. Kelly writes, if I sell Bitcoin to but another virtual currency, is there a vehicle similar to a 1031 exchange? I don't believe there's a vehicle similar to a 1031 exchange. Matthew, I know you're on the webinar here. I don't see that being a 1031 exchange. Anita asks, upon our death, are Bitcoins or crypto for tax purposes based on our acquisition base or the value at the time of death? So you would get an adjusted cost basis at death because the government treats us as property. Essentially, you would get the step up in basis. I would think yes, unless Biden gets his way, then he's potentially monkeying with that. Taxation of crypto is a payment made using virtual currency subject to information reporting. Yes. If you use crypto, it's in this sense, the government is saying crypto is property, but it also acts like money. Okay, so if you pay someone in crypto and you pay them more than $600, it's got to be reported to the IRS, not the IRA. And it includes rent, salaries, wages, premiums, annuities, and compensation. Okay. And here's the other one. If you, in the course of a trade or business, make a payment using digital currency, Bitcoin, or whatever, of $600 or more to an independent contractor, yeah, you got to file a 1099 miscellaneous, okay, using the fair market value of the virtual currency. And the big one, and this is one that trips people up. Are payments made using virtual currency subject to backup withholding? What is backup withholding? If you pay someone more than $600, an independent contractor, service provider, they have to give you their taxpayer identification number. So for an individual, that's a social security number. For a business, it's the taxpayer identification number. If the individual does not give you their own social security number, right, or a taxpayer identification number, you can actually get a taxpayer identification number as an individual to keep your own social security number confidential. The taxpayer you have to withhold 24%. Okay. I don't see how this works with blockchain. This is, when I saw this getting ready for this, it was like, are you kidding me? And remember, blockchain is public record. Okay. Now, who's getting the money isn't necessarily public record. It's a lot of numbers. It's not names, but you are subject to backup withholding. And Matthew writes, there's no like-kind exchange exception. The 2017 Tax Act specified that it's only for real property. Current thinking is that every conversion from one type of crypto asset to another is a taxable event. So I would say, thank you, Matthew, fairly inefficient from a tax standpoint. But again, this backup withholding, this is really important. So, Tesla accepted Bitcoin for a while and then stopped. Some businesses are accepting Bitcoin. I have not heard of any businesses who are paying 1099 people in Bitcoin. Typically those happen in cash, but who knows what the future will bring. But you are subject to backup withholding. So it's very important to understand if you are using Bitcoin to hire people to do things, you're subject to backup withholding. Are there IRS information reporting requirements for a person who settles payments made in a virtual currency on behalf of merchants that accept virtual currency? Think about Visa, MasterCard. Yeah, the Form 1099-K, right? A merchant that accepts Bitcoin, like Visa or MasterCard, and uses a third-party network, you have IRS reporting requirements. So don't think that just because Bitcoin's out there, in the ether, you don't have to have all this reporting. You do. Will taxpayers be subject to penalties for having treated a virtual currency transaction in a manner that is inconsistent with this notice prior to March 25th of 2014. Yeah, it's retroactive. So if you now 2014 is a long time ago, but you can be subject to. So in a sense, this is kind of retroactive. That is the end of our crypto taxation and of crypto and how to hold it. So the big takeaway is I would suggest to use a wallet. We do have, here's our website. We have a, if you'd like to make an appointment, you can click the request appointment and follow the prompts. And we do handle estate planning, trust administration, and advanced matters. I would really encourage you to look at our YouTube page. We have a lot of great content on there. And I will open it up for questions. So if anyone has any questions before we wrap it up, go ahead and put those in. Matthew, I want to thank you for your input. I really appreciate that. And if anyone has any additional questions, we can go ahead and answer those. I'll give you guys a couple of minutes here. Amy says, thank you. Thank you. That was fun. Okay. All right, Amy. It was fun too. So very exciting. But I will tell you, lawyers don't know. When I talk to other lawyers, they're like, I don't know anything about crypto. And here we are counseling people on how they should title crypto. And this is just an example of how practicing law is essentially a lifelong learning process. Val, hey, it was great to see you here. And with that, it looks like the Q&A, looks like we are done. So thank you for attending today. And if you'd like, you can go visit our website and go ahead, subscribe to our YouTube channel, and you can go ahead and request an appointment on our website. Have a great day.